Welcome to the D-Shift podcast, where we provide inspiration, motivation, and education to help you transition from the challenges of divorce to discover the freedom and ability to live life on your own terms. Are you ready? Let's get this shift started. Hello, and welcome to another episode of the D-Shift podcast. And as always, I have a phenomenal guest on, and I want to introduce you to Karla Kyte. She has a very unique job and role and responsibility in the whole divorce process. And it's something that I think more women need to be aware of before they make decisions moving forward about any real estate property that they own. So Karla actually has a business with her daughter. Her daughter is Kelsey Arrieta and Karla Kyte, and they are a mother-daughter mortgage team and certified divorce lending professionals. And what we're going to talk about today is how to navigate home ownership. I can't even say the words. Home ownership before and after your divorce and during your divorce, and to talk about maybe some mistakes that we have to be really careful about, because I have been with clients who have not talked to somebody like Karla, who have made a decision on their home and then have found out later on they don't qualify for the mortgage, can't pay the mortgage, just are really stuck financially. So Karla, welcome.
Thank you so much. I'm so excited to be on today.
Well, I am, because we haven't had anybody come on and talk about this, because it's a very specific area of decision making in your divorce. What got you into this very particular area?
Yeah, I'm so glad you asked. So kind of crazy. I went through my own divorce about 25 years ago. I was very new in the lending business at the time. But I knew what to do, and I took care of things. I never was not in home ownership ever. And I really took that for granted. And then, through the next 12, 13 years, I kept thinking to myself, why do I keep getting these settlement agreements? Why are they asking me first if we can actually do this? Their attorneys are putting them into agreements that we can't actually execute. You have to refi at a certain time or, whatever. And I just couldn't figure it out. And then I actually was talking to a mediator about it. And she said, well, do you have your CDLP? And I didn't even know what that was. So I went home and figured out what it was and did the certification. And, I think that's just the biggest thing about that is that even when I got it in 2017, it wasn't as useful as I think it is today, because with the interest rates being higher and the cost of housing going where it has gone, it has been more and more difficult for the divorcing clients to figure out how to navigate this and remain in home ownership. So, so that's kind of how I stumbled into this.
Yeah. And I'm going to ask you a question, because I am a super people that have listened to this before know this. I'm super passionate about when I make a referral to one of my clients, to anybody, I make sure that they are certified in managing the specifics around the divorce. So can you maybe just talk about, why can't you just go to your bank and say, hey, I'd like to get a mortgage, or go, shop around with a mortgage lender online? And some of them are offering crazy good deals, but they're not divorce. They're not trained, they're not certified divorce lending professionals. Can you talk a little bit about the difference?
Yeah. So I actually have a business on the side that does specifically divorce mortgage planning. And that's really to help you through the process. And so I'm there with you, and we're running numbers to make sure that what you're agreeing to, you can actually qualify, or you can go to the table and ask for these things. Hey, instead of getting, $20,000 a month for the next 24 months, I need to actually have it last longer so that it will help me to qualify for the mortgage. And so we'll talk about, what does that look like? Let's make it less monthly and make it last longer so that you can not only get a mortgage today, but you can look at refinancing down the road too. So, I do a lot of upfront planning with them. The CDLP certification is phenomenal for any lender that would be watching this. I highly suggest that you get the certification. But there are many, many, many lenders nationwide that have the certification and don't use it quite to the extent that I do. So, you can go get all these different certifications and put letters after your name. But this is actually what I do 100%. So my daughter, Kelsey, actually handles the lending side of the business. And when I get a client coming to me, I can really look at them and their situation more objectively and figure out, like, do you remain in the home? Do we, look at you assuming the loan? Or do we look at you refinancing to do a buyout with your ex-spouse, or maybe selling the home and purchasing a new home? It allows me to really look at them in a different light and not be like, how can I turn you into a mortgage? How can I turn you into a mortgage right away?
Right.
So I think that's really the big difference.
Thanks for explaining that. And I want to also point out something else that you said. And I know we're going to talk about loan assumptions a little bit later here, but one of the things that I think is a big issue, particularly, well, it doesn't matter whether you're a woman or a man. You hire a divorce attorney. And now there are some divorce attorneys that are very pro getting other professionals involved, like building a team. There are other divorce attorneys who like to kind of do it on their own. But here's the thing. Every one of the people that's a divorce specialist provides specialized information and support in one area of the divorce. And your lawyer does your legal services. Your legal services are not your tax services. They're not your mortgage services, and they're not your real estate services. So it is really important, if you have a mortgage and you don't know, number one, can you afford to carry the mortgage? Does it even make sense to stay in the house? Talking to somebody like Karla is a first step before you even start discussing that with your attorney. So, Karla, let's talk a little bit now about this whole idea of assuming a mortgage. So that can be a really tough road for a lot of women who maybe don't have the kind of career where they could qualify for that. Can you talk about that? And or not career, but income. I'm sorry, I misspoke there. So can you talk a little bit to that?
So first of all, I think, so the biggest misconception out there, and I'm going to give everybody listening to this a huge freebie. The biggest thing is that, during COVID, almost everyone did a refinance so that they could take advantage of those screaming hot low rates, right? So therefore, I would say the majority of people are in a Fannie Mae or a Freddie Mac backed loan. Okay. Those were the good, sweet loans at the really low interest rates. If you look at your closing package, you will see that it is not an assumable loan. And if you call your current servicer, they will also tell you this loan is not assumable. So the big thing is that what you have to do is, when you make that phone call, you have to say, I'm going through a divorce. Is it possible for me to assume this loan? Or is it possible for me to release the liability from my ex-spouse, right? That is what opens the door for the assumption to happen. So you have to disclose that you're going through a divorce. Otherwise, they're just going to say, no, your loan's not assumable, because it's not. And what they're talking about is, it's not assumable if you were to sell your house to another person and they would assume that loan. You cannot do that with a Fannie Mae or a Freddie Mac loan. But what we have found, and I actually just discovered this in the last 9 months, is that almost every single investor that I know of, I'm actually in a battle with one right now, but they will allow the assumption to occur as long as you fully qualify, and they will release full liability from the other person.
Okay.
You just have to ask the right questions.
So I'm going to ask a couple of questions, because some people that are on here, the whole idea of taking over a mortgage or buying out their partner or whatever is going to be really a new idea. So can you talk a little bit about a couple of the words that you use? First of all, what is a loan assumption, and what is that where you release the partner? What's the nitty gritty on those things?
Yeah. So there are kind of two ways that assumptions are written into a settlement, right? Into a divorce settlement. So one would be the court-ordered assumption. So where one spouse is being court-ordered to continue paying that mortgage, right? That's just a court order. The lender does not care about that. If the person that is remaining in the home and is ordered to continue paying that mortgage misses a mortgage payment, the person that has departed the property and is not responsible in the eyes of the court to make the payment, they will still be hit on their credit hard. You do not want a mortgage late on your credit. But if they actually do, so the courts can order you to go through the assumption process. That doesn't mean that the lender is going to approve it. Because, like what you were talking about earlier, what might be a legal option does not mean that it's a mortgage option ever. So they might order that you do that, and then you go through the process and you find out you can't do it. But your goal in doing a loan assumption is that you want to release the other person of full liability. So you would be the only person remaining on that loan. And you can only assume the loan in its current state. So if when you purchased the home, you took out a loan for $300,000, but now you've paid it down to $250,000, that's how you will assume that loan at the $250,000 at the exact interest rate that you had when you took out the loan. Same rate, same loan balance, nothing changes. Your ex-spouse is just removed from the loan and from any responsibility on the loan. Does that help?
Yep. Nope. That's really good. And let's, if you don't mind, I'm really going to pick your brains here today because you are such an expert on this. What do the courts look, or not the courts, what do the lenders look for a person to qualify when they want to assume that loan? Because this is where a lot of people, they assume in their heads that, well, I was on this loan before, so of course the lender will just be happy with keeping me on. We've always made good payments. Can you talk a little bit about that myth?
Yep, I've heard that. They don't care. So that doesn't matter. Your payment history with them is only important if you've not paid them on time. But they don't care that you've paid them on time. That doesn't mean that they're going to release one person from owing them money every month. You have to fully qualify just like you did when you purchased the home. So here's the big problem with this whole qualification piece. First of all, the lenders who are servicing your loan right now, they're not really equipped because nobody's really done loan assumptions since like the 80s. So they're not equipped, number one. They're not staffed for this. They don't have, like, I'm a loan officer. They don't have loan officers in there helping you. So when you purchased your home, you probably used a loan officer at the bank, a mortgage broker, a mortgage lender, whatever. But you had that person that, believe it or not, as difficult as it was to get through your mortgage, they were helping you get to the closing table. They were there to talk you through and coach you through, help you with the conditions for the underwriter. And like I said, it might have been a battle, but believe me, most of us don't get paid until you actually close. So we are your biggest champion in your corner to get you to the table. When you're doing an assumption, you don't have anybody helping you. You submit your paperwork and they take your paperwork and give it to the underwriter and they put you through a manual underwrite, which means you have to fit perfectly in that box.
Right.
The problem is that consumers don't know what that box is. So if I just went through a divorce and I was awarded $20,000 a month for maintenance, and my mortgage payment is only $3,000 a month, well, it makes sense that I should qualify just fine, right? That to me is a no-brainer. But you have to meet the guidelines and the criteria of the lender to be able to qualify for that. So if my maintenance, for that example, I would have had to have shown proof that I received my maintenance for 6 months. And then by the time they actually get my loan assumption done, that maintenance also has to continue for 3 years.
3 years.
So if I was awarded that maintenance for only 3 years, I would never be able to use it for qualifying, right? I'm still getting that maintenance, but I can't use it to qualify for a mortgage.
And if you don't have a job or a career, or you're not an entrepreneur where you can show income, I mean, let's face it, we all know, and I'm not pro or against lenders, but I can see why a lender would go, if 100% of your income is based on your ex making every single maintenance payment. We all know how many exes quit paying maintenance at some point in time, or they're late, or they don't provide, or they go back to court and get it modified.
Yeah.
All of these things happen. So you can see why lenders would be a little hesitant to just go on maintenance as a qualifier.
Well, and that goes for, that's the thing. When I say we have to show you've received it for 6 months, we have to show you've received it on time for 6 months. But even when, like, maybe that's not even your main source of income, maybe you do have a job and we're able to use $2,200 a month from your job, but we need that extra $3,000 a month of maintenance to help you to qualify. So we don't ever look at it like, if it's your sole income or if it's just part of your income, it's just looked at as income, and it can either be used or it can't.
Right.
So, and I'll tell you what, like, we struggle just on a normal transaction proving income. Like, if you're self-employed, if you're working part-time, if you don't have a guaranteed 40-hour-a-week work week, it's hard enough to prove income as it is, but then you throw in support income and it's just a whole new game.
Yeah.
Right? And divorcing people, consumers in general, don't understand what underwriting guidelines are and how they work.
Right. And sometimes when the underwriters come back with the information they need, it doesn't seem to make a lot of sense to people. I had a client who had an older home, was told she would get the mortgage, no problem. And then the underwriter came back and said, we need a roof inspection. We need, a plumbing and electrical inspection. She has an older house. She knows there's problems with these things. Right. And, so she ended up having to spend, like, I think $10,000 or $20,000 to bring the house up to code, to get the roof repaired. And then, I think it took her 8 months to finally get, and she got a horrible interest rate on it too, by the way. But anyhow, it took her like almost a full-time job to figure out what the underwriter needed, because it didn't all come at once. It came in dribs and drabs, and it was like, okay, this will be all we need. And then next thing you know, no, there was another big something they needed.
Yeah.
So what do people, like, if they are stuck, is there somebody to help them? Like, can you help them, or how does that work?
Yeah. So with my side business as a divorce mortgage planner, I do help people with the assumption process. I have to be really clear about that I cannot offer any guarantees, because I am not, even if I was an underwriter, I would not be the underwriter that's underwriting their file at the time of the assumption. So, but I will help them to put their best foot forward. And I can usually tell them right out of the chute if they won't qualify. I spoke to a girl about 4 weeks ago that she started her assumption process last November when her divorce was final. Her lender that she was working with would not communicate other than snail mail. No email, nothing, only snail mail. She went back and forth with them, I think 3 times. And she finally learned, it was the week that she had reached out to me, that they denied her assumption. But I told her in a phone call, literally in 3 minutes, I worked the numbers up and I said, well, you don't qualify. But what she needed to do was she needed to get her maintenance. They had made a separate agreement, and he wasn't paying her maintenance yet. So I said, get your maintenance going. And now she'll be able to apply for the assumption in January. So she had to extend her agreement with him to remove him from the loan in a certain time frame, right? So, like, had she been working with me during her divorce, we would have set that up from the beginning. She would have started getting her maintenance in November, and she could have applied 6 months after she received her 6th payment.
Right. And every time you have to file one of these motions, get an extension, do whatever, you're probably going to be doing it through your attorney. And that's like cha-ching, cha-ching. That's more money. Right?
Yep. Modifications. That's what I tell people. It costs much less to do it right than to do it over.
Yeah. And there are also, and I don't know if this is appropriate, so tell me if it's not, but there are some special companies and there's some special programs that are available for people going through divorce that may be in one of these kind of not as clear-cut ways to assume a mortgage. Is that correct? Are there some options out there?
Not really. There's nothing for divorcing people. I don't know. There might be a lender out there that is calling something that they have, divorce friendly. I mean, we have what are called non-QM products that, like I had a client in June that she had only received 2 months of child support. And so I was able to get her loan done. But here's the problem. When you take advantage of those types of loans, you generally have to put down more money and you take a higher interest rate for those loans. So ideally, like that's what I do with my divorce mortgage planning is I help people set themselves up for the best loan, not just for any loan that they might be able to stumble on, but the best loan. So we're looking at a Fannie Mae, a Freddie Mac, or an FHA loan, something that is offering like what that going interest rate is today for clients. That client took her interest rate was 1.125 higher than what I could have gotten her in a Fannie Mae interest rate.
And that adds up over time. Like it doesn't.
Oh yeah, and she has to refi now.
Yeah.
So we have her already. She's already in. She will be in for a refi in February after her 6th payment. We'll refinance her.
Wow.
So it's unfortunate. I actually just saw her last night. Bummer.
Yeah. But this is the thing, like you do the best with what the information you're given, but you, as the person going through the divorce, you have to take responsibility to reach out to professionals that do these specialized services for you. And, obviously now, Karla, you are located in
I'm in Denver, Colorado.
I thought it was Colorado. I was pretty sure about that. Now, can you work with people all across the United States, or are you restricted to just the Colorado state?
Yeah. So for the divorce mortgage planning, I can pretty much work with anybody. But I do let them know, like, I don't know your state laws. But lending is more of a nationwide, like Fannie Mae is the same across the whole nation. So, I mean, there's some nuances and differences that I'm very upfront and transparent about. I can lend in almost every state. So, yeah, it's just one of those, they would just have to schedule a consult with me and I will be completely transparent with them if I can help them or not.
Right. And like you say, I mean, so many, like the federal Fannie Mae and Freddie Mac, did I get that right? Those are federal, right? So, I mean, they're going to be pretty much the same all over. So anything else that you see that's kind of a big misconception or mistake that women in particular make when they're doing this?
So honestly, I work with a lot of amicable couples and I will work with both parties, which is really awesome because I can really help them both remain in homeownership. What I see a lot of times when people are amicable is that they will kind of make up their own rules and they won't follow the court order. That doesn't work. People leaving open joint accounts so that they can funnel the support money back and forth. That doesn't work. So it's just really, people don't have an understanding of what it will take to get a mortgage. And I hear all different ideas out there from consumers. And to be honest with you, if you're in this position, you need to talk to a CDLP. There's a lot of us nationwide. I am one of the very few that my practice is 100% working with divorcing clients. So, and I can say that pretty much nationwide. I think everybody else, I'm fortunate because I have my daughter and she handles all of the first-time home buyers and everybody on the other side of it, right? So I'm incredibly fortunate that I can just pursue this because being able to help people. I just wrote a little piece this morning and Mardi, I'll send it to you after it posts on social, but it was kind of about how how this all happened and what really fills my cup today. And this is what fills my cup.
Yeah. And it's obviously, I mean, you're so experienced and you have such a level of expertise, but you can explain it. So even somebody like me can understand it. So that's saying something. But Karla, one thing that's interesting. You mentioned that thing about joint accounts, because I actually was told by, I won't say who, but by somebody who said that this is a game that somehow is getting played, that the spouse paying maintenance insists that the joint account stay open so that it's easy to put the maintenance payment into the joint account. And that's not always what they're trying to do, because if it's a joint account, you can't assume a loan based on the money that's going into that account, right?
You
it causes,
can't use it, right. You cannot use it as qualifying income
right,
because it's,
has to go into a separate account. Yeah.
yeah, it really needs to be paid from individual accounts. And that's not meaning like, let's say that so-and-so goes and gets remarried. They can pay you from their joint account to, and maybe you're remarried too, to your joint account.
Right.
That's okay. You two that used to be married can't keep that joint account and paying money back and forth.
Right. Right. Yeah. And apparently this is something that is kind of getting out there as a way to, complicate the process for your ex to do this kind of thing. So and again, that's not necessarily something your attorney's going to be aware of. And
No,
so
they won't be.
you need to be very clear that you want this money going into a separate, your only account, not funneled to the joint. So, Karla, we have covered a ton of stuff here today and really important stuff here today. Of everything we've talked about, what do you want people to walk away and keep in the top of their mind?
Get with a CDLP very early in the process. We will work with you throughout your entire divorce and, just make sure that you're set up properly. Keep in mind that, divorces take a long time and we have guidelines that change and they can change during that time. So we can only give you the best advice at the time to help you remain in homeownership. But gosh, if you are going through this and you are in homeownership or you wish to be in homeownership after this is over, you really, really, really need to make sure that you are set up properly. I can tell you homeownership has been a complete game changer for my entire life.
Yeah. Yeah. It's that extra little bit of security. It's that something that's yours and that's, makes your own little space. Karla, if people want to find out more about what you do or want to reach out to you for a consult, what's the best way to find you?
Yeah, probably the best way to find me is through Cross Country Mortgage, karla.kyte@ccm.com, or you can do Kyte Team, KYTETEAM @ccm.com. That's probably the best way to find me, and we can just take it from there.
And I'll make sure all that information is in the show notes. Karla, thank you so much for being here.
Mardi, thank you so much. This was really fun.
Oh, it's been a fantastic conversation. And I want to thank everybody for listening in. I hope this was helpful for you. And I hope you find, if you're in this position, that you can continue to have home ownership during and after your divorce. And don't forget to tune in again for the next episode of The D Shift. Thanks for listening and supporting the D Shift podcast. If you would like to attend live trainings by our amazing guests and have a chance to ask questions and get answers from our experts, join the D Shift crew. For more details and to sign up, head on over to www.divorcecoachforwomen and click on the podcast page.